Hello, I'm Clifford Bennett. Thank you for joining me. It's a really exciting year for stocks. They're going to go a lot higher. But unlike last year, we're at the start of the year in the first week of January, and last year I was able to tell people we've already seen the lows for the year. It's a little bit more difficult at the start of this year. It's a little bit less obvious. We have a lot of people out on the market saying the market is fully priced. Of course it isn't. Corporate revenues, corporate profits are going to move a lot higher this year, driven by both domestic United States benefits, but also strong revenues from the rest of the world as well. So corporate profits are going to be going a lot higher, which means PE ratios, if they're even going to stay at the same level, the stock prices will be moving up. And I think PE ratios can go a lot higher. We're just above the long-term average around 14. We're near 15 in terms of a lot of the S&P 500 companies or the average thereof. And I think that PE ratio, when we're really towards the end of what I've called my grand bull market now for several years, when we're really going to have a major correction, PE ratios will be at least 18. They may be even 21, 22, and that's just the medium-term correction. The big long-term pullback will only come once we get up to 30, 31, 32 in price-earning ratios. That's when the market will be exuberant. It's reached those levels before. That's exuberance. Having PE ratios of 15 is not exuberance. There's plenty of room for the market to go higher. It's not fully priced at all. Please avoid that scenario. We've had a couple of things at the start of the year. Chinese data that everyone's trying to sort of run down and say, look, China's slowing. It barely changed from 7.8% in the third quarter to 7.77% in the fourth quarter, and I think we're accelerating probably in the first quarter. And that's unusual. Often the first quarter of China slows a little bit. I think we might see some acceleration. In the United States is probably the bigger risk in terms of global growth story at the moment than China, given the deep freeze, the severe weather. And if you read my note, you would have noticed that I was talking about what I call the snow cliff, which is that economic data is going to fall off the cliff a little bit in the United States as a result of the deep freeze events in early January. There's no doubt about that. You can't have most of the country come to a standstill for several days and not expect that to turn up in the economic data rather severely. It will. The market doesn't seem to be talking about that very much, which to me makes it a little bit of a risk. In other words, it might be a surprise to a lot of people just how severe that economic falling off a cliff in terms of the economic data experience is. In terms of the overall economy, the underlying economy obviously is still very strong. It was made dormant for a period, but it's still very strong. The United States is going to have 3.9% growth this year and perhaps higher. So the outlook is positive through the year. I'm just wondering if we can see a little bit more volatility in stocks at the start of the year. We should be taking advantage of this opportunity, I believe, to certainly be buying on the dip those stocks that you like. Thank you.